Welcome back to A View from the Street. I'm Michael Drozd, CIO at LaSalle Street. It's my pleasure today to welcome Bob Elliott, co-founder and CIO of Unlimited Funds and former head of research at Bridgewater Associates. Bob, welcome to the show. We're so happy to have you.
Yeah, thanks so much for having me. It's great to join you. Some exciting times in the markets here, for sure.
Yeah, rather uneventful to start the year, right? To say the least. And we're really excited to have you on as a guest, Bob. You and I chatted last week, and I mentioned this to you. I consider you one of the most knowledgeable macro investors on global Wall Street, and really at the vanguard of what the industry is demanding, especially from the liquid alternative space. So before we go into what's going on in markets, what's going on in macro, I'd love to hear about what you're doing at Unlimited Funds and the genesis around that. And full disclosure, we have an allocation to your macro strategy. Your multi-strategy ETF and our multi-asset class solutions. So, we'd love to hear about the genesis of HFND.
Yeah, well, so I've spent a couple of decades as a systematic macro investor, and as you mentioned, much of that career at Bridgewater Associates on the investment committee and leading research there. And my time there, I sort of increasingly realized that 2 and 20 strategies, which is basically hedge funds, private equity, venture capital, things like that. Those strategies, they're pretty good for the manager, and they're not necessarily great for the investor. And the reason why that is the managers managers in general produce plenty of alpha. The problem is that they often take it away in fees. And then on top of it, for taxable investors, which, obviously a lot of the folks that you work with fall into that category, often those funds are structured in a way that are quite tax inefficient. So you have high fees and high taxes, and you put that together, and a lot of individual investors are not that much better off than they would be on their own, or with more of a passive allocation. And so our idea, starting a couple of years ago, was, can we figure out a way to bring concepts of diversified low-cost indexing to the world of 2 and 20, starting with hedge funds, since that obviously is where my career started. And the idea there is, instead of investing directly in the funds, and I'm sure there's lots of people who've heard about sort of access to alternatives. Lots of that stuff is layering fees on top of fees, because you got to pay the manager, and then you got to pay the platform, and then you got to, and now we've got fees, and you got to pay the government, et cetera. And so our idea was instead to develop technology using our couple decades of experience having built proprietary hedge fund strategies that allows us to look over the shoulder of hedge fund managers in real time, understand their positions, and then take that and translate that into long and short positions across the 60 different global liquid securities that back an ETF. And the ETF is great because it's liquid, it's transparent. We can run it at a much lower cost, and that way, the everyday investor can basically get access to diversified hedge fund strategies, at something like a quarter of the fees and half the taxes of typical LP structures.
Yeah, I mean, that's incredible, and a perfect example of how you're on the forefront of what really the industry is demanding, and you hit it on the head from an overall cost perspective and transparency perspective. For sure, that's what the industry is demanding. And while you can mirror or replicate, some of those positions with existing hedge funds and traditional LP vehicles, a really, really smart way to bring that to the masses and really provide, in my view, additional diversification to portfolios, and really from a perspective of where we are in the current economic cycle and the range of probabilities expanding, and what that means from a portfolio construction perspective. So, yeah, and even in my own right, coming from the ultra high net worth and family office space, and spending some time on global Wall Street working with these folks, and you hit it on the head from a cost structure. The question becomes, who is that really benefiting, right? Of course, there's some really strong managers out there, so I don't want to diminish some of the really good top performers out there, but the reality is when you put it in a structure, just as you described, that's transparent, that's a lower fee structure, and can really provide that similar sense of exposure within the portfolio. It's kind of in my view, the best of both worlds, right? So, so thanks for sharing that.
Yeah. I mean, ultimately, what investors care about is, their net of fees, net of taxes returns, and how
Exactly.
that outcome can help in a portfolio. And so that's what we're really laser focused on, is how do we give access to the strategy styles, right? To the insights, and the agility that these, managers bring, and they do generate lots, and generate plenty of alpha, before the high fees that are being charged. How do we give you access to that sort of product without without the challenges of the existing infrastructure? And then on top of it, one of the benefits, particularly from an advisor's perspective, is cutting down on the paperwork. How do you
Yeah,
get
exactly.
access to these sorts of strategies? Typically, you'd have to do subscription docs and K1s, and honestly, and you'd have capital lockups, and you'd have notice, and you'd have to, certain people could get access if they were qualified versus accredited, et cetera. The nice thing about an ETF structure is you get access to those strategies, a diversified set of manager strategies, but all you have to do is trade it like any other ETF, rather than have to deal with all the hassle, honestly. And you can do it
Exactly.
for, clients for $10 million, or, $10 million allocations, or, $10,000 allocations. That's the other nice thing about ETF structures. You can tailor it to, whatever client size that you have.
Exactly. Yeah. I mean, you hit it on the head. The streamlined process of just being able to place the trade right at the ETF level removes all the hoops that you have to jump through, even at the QP or accredited investor level, and really the documents that are involved in subscribing in an LP vehicle, right? Sure, I completely understand, right? So, well, look, again, we're always amazed by what you're doing. Like as I mentioned before, you have a really keen sense for what's going on, not only in the industry and launching these sorts of products, but from a macro perspective. And shifting gears a little bit, entering 2025, I think you had a really interesting perspective on what may transpire, and really in alignment with our views as well. And for the most part, we simply made the case that the policy sequencing coming from Trump 2.0 would be very different than Trump 1.0. And really, with extremely high earning expectations, we thought there would be more uncertainty for asset markets and how they would react going into to 2025. And we for sure have seen some of that volatility, especially over the last few weeks, right? We've seen the S&P 500 dipping into correction last week, the Mag 7 entering a bear market, and bonds rallying off that volatility. So, just to put things in context, what was your view going into 2025, and what's your 50,000 foot view now, and how do you see what's happening in markets right now?
Yeah, well, to kick off the year, I wrote an outlook which is called "Curb Your Enthusiasm," which I think summed it up in a little bit of a quip pretty well, which was, if we look back to the start of 23 and 24, expectations for the U.S. economy were quite weak. I mean, remember 23, there was 100% probability of recession, of course, that never
Right.
came. And that was really priced into asset markets. So a big driver, well, there's a lot of conversation about all the underlying details of which companies were successful over the course of the last couple of years. The underlying macro driver of equity market outperformance was expectations were low. The economy ended up being pretty good, and therefore stocks rallied. And that's a pretty, that's a very normal dynamic, because what drives asset prices is how conditions come in relative to expectations. And so what we saw to the start of 25 was a very different set of expectations, whether it was earnings growth that was in the high double digits expected over the course of the year, as you mentioned, or it was, real GDP growth expectations at nearly 3%. Those were very high expectations. Leave aside even the subsequently learned ambiguity about the new administration's policies. Even before we got that hit, into the markets, injected into the markets, expectations were sky high, and it was going to be tough to beat those expectations for another year. And so that's sort of what set up my view of this sort of curb your enthusiasm idea of, don't get over your skis, don't get too excited about things. And that's largely played out. Now, I think we're transitioning to a point today where we're starting to see a set of federal government policies that, one could argue whether they're beneficial in the medium and longer term. It's relatively clear that they are growth negative in the short term. And part of what we're seeing in terms of pricing more recently is it's not just a growth scare. It's a recognition, I think, across market participants that there's both volatility in terms of what the policy outlook looks like, but also, let's say, a slower growth bias in that collection of policies. And so that is not fully priced into the market. A lot of the euphoria post-election has been priced out, but we haven't really seen a big downshift in expectations beyond that.
Yeah. So essentially what you're saying is, and we all know this from a F1C policy standpoint, they tend to be pretty slow to move, right? And with inflation potentially being above their target, and who knows where we are in the next few months, they're probably going to focus more on that, while there is that palpable sense of slowing in the economy, still coming off levels that have been pretty robust. So we're still hanging in there from a growth perspective. So, what you're saying is, from a market perspective, the reaction potentially still is not fully priced in just yet.
That's right. I mean, we're just getting the initial taste of some of the growth negative federal government policy. So if you think about something like immigration, we've gone from a point of immigration growth of 1 to 1.5% of population per year, and labor force growth as a function of that, to something essentially that's zero or even maybe slightly negative on a forward-looking basis. From a growth perspective, a headline growth perspective, that essentially reduces the overall potential growth rate of the economy, but it takes a while for that to flow through. That halting of immigration that really has just happened. It happened a little bit in the late previous administration, but really, tightened down in the last couple of even weeks now. We're not going to feel that until the back half of 25, or something like tariffs, where, frankly, it just takes time for, if they are fully implemented as at least discussed, it just takes time for the prices on the store shelves in Walmart to change to reflect those tariff increases. And so, again, that's sort of a second half 25 type drag on the economy that we're likely to see. And so these policies, the markets are starting to feel these policies and starting to assess these policies, even though it's going to take a little while for them to actually show up in the numbers.
Yeah. So in the interim, you're getting this somewhat stagflationary impulse, right? With inflation a little bit higher and growth trending lower. How do you foresee the actual effectiveness of monetary policy playing out on a go-forward basis? I think, they for sure have two blunt tools that they can use, and one is, of course, the policy mechanism through rates, and then expanding your balance sheet, right? And I think Fed Chair Powell came out a few weeks ago and said, there would have to be quite a bit to happen in markets, specifically credit markets, for us to actually even think about using expansion of their balance sheet again, right? So, who's in the driver's seat right now? Does it appear that fiscal policy is driving a little bit more of markets? And what I mean, the bond market, which is typically 3 to 4 times larger than equity markets, or is monetary policy as effective as it used to be, if we look over the last 40 or 50 years?
I think monetary policy was a really big driver of market action over the course of 22, 23, and to some extent in 24. And that's really, on a forward-looking basis, taking a backseat. And this is true in the U.S. context, actually also true across basically all developed world economies, where the macroeconomic data essentially is handcuffing all these central banks from meaningfully moving policy easier or tighter at this point. And so if you look at something like the Fed, the unemployment rate, which of course is what they're focused on, the core PCE rate and the unemployment rate.
Mhm.
The unemployment rate, there's a little bit of a scare last year, but has actually ticked down. It's stabilized. And if anything, the low immigration environment is likely to keep the unemployment rate relatively contained. It will not likely rise nearly as fast. In fact, nearly all the rise in the unemployment rate that we saw before was a function of lower skilled labor markets loosening as a function of immigration. And so that's stabilized. And so even if growth slows, the unemployment rate may not rise nearly as fast. And so the Fed may not feel an urgency to ease in response to that. And that's coupled with the fact that core PCE inflation, basically, it hasn't changed in 2 years. And the most recent numbers are not, actually are at the higher end of that range of the last couple of years. And so you put that together with the risk of inflationary policy from something like tariff increases, and the Fed is going to sit there and say, maybe we're not going to be proactively easing in this environment, like I think many people had expected as of last year.
Yeah, that's spot on. So kind of a slow moving train, if you will, right? And it would seem like they will continue to drag their feet just because of the dynamics that you just described. And one thing I think about from a market structure perspective is, and really what's going on in the bond market specifically, is folks and corporates that took out debt during COVID, right, at the lows of 1%. If you look at 5-year treasury, right, that actually have to come back in and refinance at a rate that's potentially 300 basis points higher, 350 basis points higher than what they're currently at. And couple that with all of the macro forces that you just described, it seems like you potentially get into not only an interesting environment. What I mean by interesting is a challenging environment from a macroeconomic perspective, but you have this wall of debt that needs to be refinanced, towards the back half of this year, third quarter of this year, and rates are still at 425, 430 on the 10-year. So, the question becomes what happens between now and then, and does the Fed recognize this, or are they squarely focused on their dual mandate as you just described?
Well, I think a lot of what you're describing is the long and variable lags of monetary policy, and
Sure.
and they have not, while the Fed has incrementally eased over the course of the last couple of quarters. Interest rates today are a lot higher than they were 3 or 4 years ago, and that effect is basically, is you kind of think about it like a lead weight on the balloon of the economy, right? It's just kind of constantly dragging the economy down to some extent, constantly eroding it. I think the thing that's interesting in terms of the markets is a lot of that repricing of debt is really is not necessarily obvious to people because it's outside the public markets and in things like private credit,
Sure.
and bank lending. And so you're seeing a lot of rolling over of the debts in those environments. And so you might see, whereas what you actually see in a lot of cases, some of the publicly traded bonds are, they were able to term them out even more than the couple of years, post COVID. And those companies actually, from a cash flow perspective, like things like high yield bonds, are showing some of the best credit conditions than they have. Today's high yield bond index is totally different from yesteryear's high yield bond index. And so it kind of creates an interesting dynamic where you might actually see public market investment opportunities that still look pretty compelling given that structure, that they've termed out the debt and the companies are a lot better than they were before. And a lot of the erosion is happening a bit under the surface in terms of with private credit and bank lending. And that has a real effect on the economy, but maybe it's not showing up in the publicly traded markets as much.
Yeah, I mean, I think you may have coined this phrase. It's like the blue chip of high yield, really, in
Right.
terms of credit quality, right? And credit quality may not be as a result of balance sheet issues at the company level. Just maybe first time issuance. There could be a number of reasons as to why they are rated at high yield too. So there's some nuances to that. And to your point, although we are starting to see spreads uptick here from a high yield perspective, it seems like it's pretty well contained. And if anything, that refinancing issue that I described is really isolated to potentially off balance sheet or more of an opaque type of product or vehicle, if you will. So yeah, like really good insight. Yeah. So again, I mentioned earlier, and I think you hit on it as well, in an environment where the range of outcomes is pretty vast, meaning you can make the case for a bull market in equities, and although that case may not be as robust as it used to be, but you can also make a case for a pretty palpable kind of drawdown in equity markets and some consternation amongst market participants too. So I always think about what does that mean from an asset allocation perspective, right? And portfolio construction, knowing that the environment that we're in, although it's growth is moderating and slowing, although inflation is potentially kind of flatlining a little bit. What does that mean from a portfolio construction perspective, and what assets should clients be thinking about outside of your traditional 60-40 mix that worked so well over the past 40, 50 years of relatively good growth and zero inflation or very low levels of inflation?
Well, I think the uncertainty that we're facing right now in terms of what the policy outcomes will be really favors increased diversification in a portfolio, as well as increasing allocation to what I'd call alpha strategies, tactical strategies that can go long and short markets depending on where the opportunities are. And in particular, I know a lot of people have eschewed bonds for a while, thinking that they're not a great hedge. I think one of the things that's kind of interesting is now what we've seen over the course of the last couple of weeks is bonds maybe aren't a perfect hedge, but they certainly are a better hedge to a stock slowdown than they've been for a while. Stock fall than they've been for a while, and so it probably at these valuations, it's probably worth coming back to bonds to some extent, even if you weren't so excited about them for the last couple of years. I think also it highlights that gold might have a role in a portfolio here as well. And I know you folks hold gold in your portfolio. One of the rare allocators to gold. The vast majority of RIAs don't hold any gold, literally zero gold in their portfolio. And obviously what we've seen is that gold has been a unique and dynamic hedge in an environment of higher than expected inflation and higher than expected geopolitical risk and monetary and easy monetary policy. And so I think it certainly has an important role in a portfolio. Now, you're probably not going to hold as much gold as you do bonds, partially because gold is much more volatile than bonds, but certainly having a moderate allocation to gold can be very beneficial in this environment. And then, as I said, the last thing is really looking at alpha. So where can you add strategies, low cost diversified strategies that can go long and short markets? Because we might have a period where we have meaningful shifts in economic conditions where, say, something like stocks are going to underperform. Where are the ways that you can you have sort of a question of, do you manage it yourself, or do you hire people who are skilled managers to navigate through that uncertainty and tactically shift positions? And I think it's one of those times. A time of great uncertainty is a time to hire the best and the brightest to navigate through the choppy waters. And so I think alpha is a good good. It's a good time to add diversified alpha to your portfolio after, what the previous 2 years is basically like get long, and the longer the better. The next 2 or 3 years are not going to look the same way.
Yeah, I mean, what you're speaking to is diversification for the unknown, right? I think peak diversification is consistent with the uncertain environment that we're in, and what better person to have on our call than you, who runs a strategy that you're essentially describing, right? So, again, very happy to have you on. Really looking forward to continuing our partnership. So, we're coming up against, the hour here. Any final thoughts for our viewers? Anything that we should be thinking about on a go-forward basis? Something at all?
Well, I think it's easy, either as a client or in an advisor's seat, to extrapolate, what has been a certain market environment over the course of the last couple of years into the future. And in a lot of ways, what we've discussed is, a lot of strength is already priced into the markets. And so this is maybe a time to start to think about, how do you lock that in for your clients, before things turn? How do you find things that maybe are a bit, have that, that beneficial convexity in a down market environment, in order to put yourself and your clients into a position where, if we do end up getting a market environment that looks, more than just a short-term correction, something that, looks like a choppier or more negative environment that maybe is reminiscent of, decades past. For those who've been around long enough to see them, you want your clients to be able to have enjoyed the gains of the last couple of years, and not necessarily give those up if we have a more challenging market environment.
Yeah, I mean, what you're saying is ultimately, the gains that we've experienced over the last few years. Of course, there's a certain component. No one wants to pay taxes on their gains, but that's really the toll that you have to pay for good performance on markets, right? So think about rebalancing, peak diversification, and ultimately think about strategies that you run that can ultimately deliver the types of alpha and beta exposure that you're describing. If you want to do that, we have solutions here at LaSalle Street to our own multi-class solutions. Bob, where can people find you to get in touch with you? Can they just go to your website? What's the best way to connect with you?
Yeah, for sure. If folks are interested in getting in touch, they can check out unlimitedetfs.com, like the banner in the back. And if you want, an ongoing flow of various macro commentary that hopefully is just helpful in terms of informing yourself and navigating this environment, being able to talk to your clients about navigating this environment, you should definitely check me out on X. I'm at Bobby Unlimited, as well as on YouTube at Bobby Unlimited. For the younger generation, I also do TikTok videos. No dancing, but just cold, hard macro truths first thing in the morning while I'm walking the dog. So you can check that out.
You may get some more views if you dance on it, Bill.
Nobody wants to see me dance.
Point well taken. Well, again, Bob, thanks for your time. We appreciate it. Really looking forward to our continued partnership here. Really wish you all the best, although you've been very successful on unlimited funds. I know you have some other products coming down the pike here, so we're looking forward to the launch and release of those. And for everyone out there, thanks for tuning in to A View from the Street. Be sure to tune in to our next episode, and thanks so much.
Thanks for having me.